And thanks, Sonal, for giving us all of that data. We have Vinod Rohira, who's the CEO at Mindspace Business Park REIT, and Gaurav Kumar, the MD Capital Markets and Residential Business at CBRE India, who join in, who've tracked this space for a very long time. Gaurav, I want to begin with you. You know, as Sonal was telling us, the rental yields for REITs is not very high. I mean, if you look at it for Mindspace itself, it's about 5%. Brookfield is 6.5%. Embassy is 5.9%. So I want to understand that from an investor standpoint, what makes more sense, investing in a REIT or investing in the commercial or the residential property itself?
You know, firstly, I'd like to make a distinction between residential yields and office yields. I heard a commentary from one of your colleagues which said that in India, yields are around 2 to 3%. I think she was referring to the residential market. In office, Indian yields are definitely north of 7% at an asset level. Clearly, REITs is great from 3 or 4 perspectives. One is governance. You know, one of the biggest talking points about Indian real estate is transparency and governance. And what REITs clearly offers to both institutional and retail investors is a very, very strongly regulated platform in which they can easily enter and exit at will, right? So you have the option to sell when you want. You have the option to enter into a professionally managed portfolio. Like you rightly said, vacancies are coming down. Pre-COVID vacancies were single digits. Post-COVID vacancies will naturally gravitate to single digits as well. So I wouldn't be too focused on what the in-place yield that you show. I'm sure Vinod can throw more light on what's the exact yield or the return to investors that his REIT or the other REITs have offered. But remember, REITs have an inbuilt rental arbitrage, right? So your mark-to-market index on rentals for all 3 REITs are very, very good. All 3 REITs have performed great in terms of increasing occupancy since they have listed. And you know, if you give it a couple of years in the post-COVID environment, your total return to equity shareholders from the time they've listed will only go up, because these REITs also have the opportunity to make new acquisitions. They have the ability to make off-market acquisitions. They're tax efficient. And from an institutional or a retail investor's perspective, whenever they invest in a REIT, REITs are obligated to distribute majority of the dividends, right? So there's no window dressing, there's no decision-making or discretion at the sponsor level. Whatever is being earned from the portfolio is being distributed out. Now, if you try and go out and buy an asset yourself, if you're a retail investor, it's impossible to manage that asset, right? You don't have a professional manager in the middle. You're directly exposed to any churns that are happening in tenancies. If there are any issues in the building, you're directly managing that. So it's clearly not for the lighthearted if you're a retail investor. As far as institutional investors are concerned, I think REITs is for a separate category of institutional investors. It's for listed investors who like the liquidity.
Sorry, that's basic. Sorry, Gaurav. You know, we're just showing pictures of listing of the Tamil Nadu mercantile stock. I mean, it's on your screens right now. Those are the first ticks coming in. The management team, of course, sort of ringing the gong, signaling the listing on a market. Sorry, Gaurav, continue. Please finish that point.
So I think, you know, clearly it's a different platform for investing into commercial real estate. It's for a different category of investors. Yes, you have private equity funds who directly like to own real estate, but many of those private equity funds also use the REIT model to exit, to monetize. And, you know, it'll only help in increasing the depth of the market. Just as a comparison, the US REIT market is $1 trillion market. And it's almost 50% of their total real estate economy.
Right.
We are a far distance from that. So, you know, great outlook as far as we are concerned.
Right. Let me put that to Vinod as well, who's with us. Vinod, good morning. Thanks for joining in. Do you want to weigh in? You know, Gaurav made excellent points. I mean, your perspective on the yield argument?
Okay, so primarily, I think what's important to add to all this discussion is that we must be clear that when REITs are distributing dividend, you are not paying any tax on that dividend. So you're actually making, if for example, 100% of the distribution is dividend, then you're paying zero tax as the marginal rate of tax. So when you distribute 5.5% or 6%, and in our case, at 93% of our distribution is dividend, it's completely tax-free. So your effective return is far greater. At the same time, to add to what Gaurav mentioned, when you're looking at an asset manager who's handling grade A assets with an occupier who's primarily tech, 90% of commercial real estate in India is occupied by tech, and that's global tech companies. They have a very different rhetoric when it comes to looking at what commercial assets they want to acquire and occupy, because they are attracting top talent. And with millennials coming to the workplace, you want to keep them excited at the workplace. Otherwise, they're going to carry their resume next week somewhere else. So while the landlord is not a dominant participant, he's actually a very, very active participant in ensuring the experience offered at the office. And that's really changed the game, which is why if you see in the last 9 months, grade A assets have got completely leased much faster at a rate than whatever is the macro level of vacancies in those micro markets. And that's the trend that's going to continue, and you're seeing rising rentals. Second important thing for a REIT, if I may add, is that you must see the intrinsic value of the asset embedded.
Yes.
At an average rent, for example, at 63 rupees for us, you want to replace those assets in those primary markets. You won't be able to buy land, build and lease at those rents. So you know there is a massive embedded value. So when you're looking at a REIT, you're looking not just at dividend distribution, you're also looking at the intrinsic value of asset. And at the same time, that's where your total return comes out.
Got that. Vinod, very quickly, is there scope for rental yields in the commercial space to go up in the near future?
Rents have already started firming up. See, what's happening is inflation becomes your best friend. Nobody's bringing in new supply. New supply cost is much higher. The access to debt is not available if you're not AAA. If you just put a little bit of a crystal gaze on next 24 to 36 months, you don't have more than 50% of the supply you saw in 2019. And with the rents firming up and the demand firming up, you know where it's going to go. You bring the right supply in right now, you're a winner.
Okay. All right. We've actually run out of time, not out of questions, but Vinod and Gaurav, thanks a lot for joining in. So there is definitely a pickup. And there are different ways to approach the real estate sector, right? Of course, buying property outright, investing in real estate stocks, and REITs is the third option, which is proving to be very fruitful at the moment. But let's move on. The Tamil Nadu Mercantile Bank listing has taken place on the exchanges. You just saw that on the screen. It's not been a very good listing, a bit lackluster over there, at least the last time I checked. It'll come up in a bit. Yes, there you have it, absolutely flat right now. Let's take a quick break. Up next, Mitesh Thakkar will be joining in for some technical trades. Stay tuned.